You want to start a trucking business. You've got $175,000 in cash. 0 trucks, no customers, and 100 days to turn an Indianapolis trucking startup into $1 million in billed revenue. The catch is brutal. You're not buying a fleet. You're building a leased-on dry van carrier from scratch. And one bad insurance quote, one weak broker, or one ugly claim can eat the whole pile before a single load moves. So the first thing you do is not buy a truck. That would be the expensive rookie fantasy. Instead, you form an Indiana LLC, grab an EIN, file for U.S. Authority, pay the $300 FMCSA filing fee, line up a process agent, and start the insurance gauntlet. You also set up a drug testing consortium, ELDs, driver files, UCR, IRP, UFTO, the whole alphabet soup that keeps interstate freight legal. It's boring, expensive, and absolutely non-negotiable. By the time you finish the setup phase, you've burned $63,000 before hauling anything, and your remaining cash is down to $112,000. That number feels healthy until insurance comes back $11,000 higher than expected on day 16. New authority, rapid growth, no history, and suddenly the underwriter is charging you like you've already crashed half of Indiana. You can slash your liability coverage and pray that brokers don't care, or you can keep the proper limits and shrink your ambitions a little. You choose the painful option. Protect the carrier, preserve the emergency cash, and accept that your first growth phase is going to be slower than the fantasy version in your head. The real business model is simple on paper. You're dispatching dry van freight under your authority, but the tractors belong to owner-operators. They bring the equipment, you bring the loads. They keep about 75% of the line haul and fuel revenue, and you keep roughly 25% for dispatch, insurance, factoring, compliance, trailers, and the privilege of being the person everyone calls when things go wrong. A new late model sleeper can cost over $150,000, so buying 20 or 30 trucks in 100 days would be financial nonsense. Leasing on owner-operators is the only version that even gives this title a mathematical chance. Before your authority is active, you're already cold-calling brokers and posting in owner-operator groups. You're hunting for people with clean records, working tractors, and the patience to trust a brand new carrier. That trust is the first wall you hit. Brokers don't love brand new authorities because they don't know if you're real, safe, or just another carrier with a logo and a Gmail address. By the time your authority goes live, you have 3 owner-operators conditionally approved and a long list of people who are still thinking about it, which is trucking for maybe. Your first loads start around day 21 and the launch is small on purpose. 3 trucks, Midwest lanes, Indiana to Chicago, Cincinnati, Louisville, Columbus, Detroit, St. Louis, short enough to manage, busy enough to keep the wheels turning. You live on load boards, broker setup packets, and 50 phone calls a day. Every load gets judged by a single question. Does it make money after deadhead, fuel, and settlement, or is it just making your dashboard look busy? That distinction matters more than people think, because a load that pays $1,800 can still be a bad move if it sends you 180 empty miles into a dead market. The first few weeks bring $42,000 in revenue and an operating loss of about $4,000. That doesn't sound exciting, but it's actually a win. You're proving that freight moves, invoices go out, and brokers pay something that resembles reality. The first 10 loads arrive without a claim, which is huge because one damaged shipment on a new authority can poison the whole pipeline. You also discover your first mistake fast. A low-paying backhaul looks fine until you subtract deadhead and realize you basically paid to keep a truck busy. That bad lane costs you about $200 in lost opportunity and operating cost, and it teaches you the lesson most dispatchers learn the hard way. Gross revenue is vanity. Contribution is survival. By day 35, the cash pressure is real, but the pattern is working. You've got a small footprint, a clean record, and enough proof to start recruiting harder. You raise the referral bonus, hire a second dispatcher, build lane scorecards, and lease 4 trailers so you're not begging every broker for equipment. You also stop treating maintenance like an afterthought. One owner-operator breaks down for 6 days because of deferred maintenance, and that failure costs you about $5,500 in lost revenue plus $2,500 in repair advances. You don't finance every repair for every operator because that turns your company into a tire fire with an invoice printer. Instead, you tighten inspection standards and demand cleaner maintenance records before trucks come on. That discipline starts to matter right when the fleet begins to scale. By around day 50, you cross $100,000 in cumulative revenue, And that first six-figure milestone feels bigger than the number itself. It tells brokers you're still standing, tells owner-operators you're legitimate, and tells you that this ugly little machine might actually grow. By day 55, you're up to 10 active trucks and about $149,000 in phase revenue. The company has finally turned profitable at the operating level, and that's the moment you realize the business is no longer a stunt. It's a system. Then comes the next problem, and it's the one that kills a lot of carriers: cash flow. Your customers pay in 30 to 45 days, but your owner-operators want weekly settlements. That means you can be profitable and still run out of money. Around day 63, you hit a temporary $60,000 working capital gap. Revenue is on paper, but the bank account doesn't care about paper. You solve it with factoring on approved invoices, which means you sell those receivables to get cash faster and keep the trucks rolling. It's not cheap, but it's cheaper than missing settlements and losing drivers. In trucking, a driver who doesn't get paid becomes your competitor by Friday. Once the factoring is in place, you start acting like a real carrier instead of a freelance dispatcher with a logo. You pursue repeat brokers, small regional 3PLs, and then a dedicated packaged food distribution account through a 3PL. That's the breakthrough that changes the pace of the whole company. Spot freight is useful, but it's unreliable and often overpriced in the wrong direction. Dedicated freight gives you predictable lanes, repeat volume, and a reason for owner-operators to stay. You add 5 drop trailers, hire a compliance and safety coordinator, and grow to 18 active trucks by day 75. Revenue for that stretch hits $279,000, and operating profit lands at $31,000. For the first time, the business looks like it has a spine. Of course, growth always asks for a sacrifice. The dedicated customer pays on 35-day terms, and your settlements still move weekly. That's where discipline beats optimism. You don't pay drivers out of pure operating cash and hope the receivables catch up. You factor only approved invoices, maintain reserves, and keep the cash buffer intact. That choice keeps the company from drowning in its own success. It also means your office gets busier, because now you're not just dispatching loads. You're handling compliance, safety, recruiting, billing, trailer logistics, and the kind of spreadsheet work nobody puts on a trucking billboard. By day 76, you hire a recruiter and standardize your dispatch process because 18 trucks are already hard to manage and 25 trucks would absolutely punish sloppy habits. You cut unprofitable Northeast lanes, negotiate a better factoring fee, and build driver scorecards so performance is visible instead of guessed. Then the business takes its biggest hit. A preventable cargo shift damages packaged goods and creates a $14,000 claim on day 82. You can hide it and hope nobody notices, or you can report it immediately, pay the deductible, document everything, and retrain the fleet. You choose the honest option. It hurts, but it keeps your insurance clean and forces better cargo securement checks. If you try to bully your way through a claim, the next thing you lose is usually the insurance policy itself. After that claim, the final stretch gets brutally specific. You're at $776,000 in cumulative revenue, which means the title is still within reach, but only if you add about $224,000 in just 10 days without getting reckless. That's the kind of number that makes bad operators start chasing sketchy freight. You don't. You get to 27 active trucks, keep weekend dispatch coverage on, lean into repeat lanes, and work 2 established brokers for short-term surge freight. You also delay owner distributions completely. Nobody's getting a victory paycheck yet. The entire company is pointed at one job: produce billable freight without lighting the balance sheet on fire. Then one broker pushes up against your internal credit limit. That's a dangerous moment, because the temptation is to keep saying yes. Revenue is sitting right there, the truck is loaded. The invoice looks good. But concentration risk is how new carriers wake up with a giant number and no cash to match it. So you stop accepting those loads until the factor approves the paper. It feels conservative. It is conservative. And it's exactly why the company survives long enough to finish the job. On day 99, a dedicated Midwest load delivers and invoices, and that single move pushes cumulative billed revenue to $1,027,000. You hit the target one day early, but the story doesn't end with fireworks. Day 100 is spent reconciling invoices, managing the fleet, and making sure the system still works after the sprint. By then, you've built a company with 27 active owner-operators, 5 internal employees, 1 small Indianapolis office, about 18 recurring brokers, and 3 PL relationships, plus 2 dedicated freight accounts. The business is bringing in a monthly run rate of about $750,000, with monthly operating profit somewhere in the $45,000 to $60,000 range before unusual claims and owner distributions. The crazy part is the margin. You built $1,027,000 of gross carrier revenue and only about $37,000 of pre-tax profit in the first 100 days. That's not a failure, that's trucking. The money moves fast, but it gets split fast too. And the real win is that you reached the title through an asset-light model instead of buying a mountain of equipment. You started with $175,000, spent $63,000 before the first load, survived an insurance spike, a bad backhaul, a breakdown, a cash crunch, and a cargo claim, and still ended with cash, receivables, trailer deposits, and a functioning carrier instead of a parking lot full of financed tractors. So by day 100, you didn't just invoice $1 million. You built a fragile but real trucking company in Indianapolis that could actually keep moving, and the reason it worked was simple. You used owner-operators, protected your cash, and refused to confuse revenue with profit.